Welcome everybody out there here to our next webinar here at JFD Bank, and a warm welcome in the name of JFD Bank and from my end as well. My name, Stefan Friedrichowski, as always, for those webinars today. It's the 23rd of January 2020, and since it's the first webinar this year as JFD Power Webinar, I think it's still a good time to say all the best for the year 2020. Okay. Today we have a totally different topic. Value at risk, an underestimated key figure. So honestly, we do not really talk about trading strategy. Although value at risk might be even a good indicator for complete trading strategy. And later you will learn that there is a German company, now 1 billion euro total value, which is more or less completely based on that value at risk. They did something out of that key figure and got really quite good resonance in the market as for investors. So let's talk about that as well. So it's a key figure, normally just for an investment, but we can even answer questions like what you should prefer, an investment in S&P 500 or maybe the DAX. Okay, you may have a look to the chart. That's always one answer to such a question. But to have an objective key figure, that's a good idea. And value at risk, as the name is already telling us, is a key figure which emphasizes more the risk side of a trade. And honestly, that's always good, because just looking to returns might be misleading and might be a disaster in the final end. Okay, but all this is only part of today's webinar, and it looks that we are once again here quite international, as at least if I guess from the names here. But that's maybe totally wrong, just looking to the names. You know the procedure. Before I really start, as always, I have to show up the risk disclaimer, because we talk about trading, we talk about trading strategies, we talk about investments, but all you do finally, you do it on your own responsibility. I think that's quite self-explaining, but it has to be mentioned during any webinar at least once. So let's start. So today's topic can be divided into the following parts. So first of all, I want to introduce you in some more key figures at all for investments, trading strategies. If you have two different strategies and you want to compare them, then we need objective criteria for that. Therefore, let's have a brief overview about other key figures. And of course, value of risk will be one of those. And that one we will really dive into. Of course, we need to know the definition of value at risk. And it might look on the first hand really complicated. Normally you talk about histograms and quantiles and stuff like that, which really sounds like a disaster. No, practically doing it with real values, it's really quite easy, you will see. So we talk about the field of use for value at risk, and I will show you some examples. I will start with the Dow Jones, with a real long history, more than 100 years. And then, of course, I want to answer that question from the beginning. What is a better investment in terms of value at risk, DAX or S&P 500? And maybe if we have still some time, you might even tell me some stock company names, and I will do a comparison with two of them, just to answer once again the question, what might be the better investment? So that is the underlying question. So if it comes to investment, we need key figures in order to compare those investments. And if I talk about investments, I indeed mean trading strategies as well. So we might have a track record of an account, or we might have a back-tested trading strategy, something like that. And now the question is, which one is better? And therefore we need key figures. Of course, any key figure does not tell you something real about the future. It's impossible. It would be nice to have that, but to have any guarantee for future behavior of whatever investment, simply we don't know. But at least we can compare the history. And the most often used key figures are first-hand return, yield. So however you name it, just looking to the return, and you might do it on a monthly base or on a yearly base, or you have a single key figure just like since inception. Especially if we talk about bonds, or if we talk about ETFs or something like that, then you have always this since inception. But better is to do analysis on a shorter time period, like monthly or yearly. And then you get a return. Okay. And I think it's the first time here in my webinars. Of course, return is not everything. And okay, high return is always nice. And normally you would not invest into something which has a negative return, but it's just one key figure. But funny enough, there are a lot of people investing money in funds or similar to funds which have negative return, and that is if you buy bonds from the, for example, German state, you get a negative yield, and yeah, funny enough, there are a lot of people buying that. They have their reasons to do that, but they buy even something with a negative return. But when we talk about trading, normally we would not go for something like that. Next to the return, of course, it's always to have a view on the risk side as well. And one key figure for showing up the risk is just looking for the maximum drawdown, which is historically from one high point or one high value, one maximum within the equity curve to the deepest down afterwards, percentage-wise, which is exactly the maximum drawdown. That's an important key figure as well, because it shows, at least for the history, the absolute worst case, which has happened in the past. So yes, important key figure. And now, since we talk about return and we talk about drawdowns, best is to compare those two. And then what you normally do is you divide return by risk, or return divided by drawdown. Then you have a quotient, which is not that bad key figure. And if you follow up my webinars here since the very beginning, sometimes when I talk about trading strategies, I have my own key figure, which is called OPTI, or profit factor. Even it's spelled here in German, but anyhow, then you know it's more or less the same than return divided by risk. It's just the other way around. Drawdown divided by return, and in this case it's not, you don't use the return, I just use the slope of the equity, but it's more or less something quite similar. And the first you want to maximize, the other you want to minimize, but that's only mathematics and no real new information. So that is good to always compare return and risk. So that is good for any investment. There's another one which is quite common and widely used, that is called the so-called Sharpe ratio. And even if the definition sounds a little bit complicated, practically that to calculate Sharpe ratio is not a big deal. Sharpe ratio is defined by the quotient of average excess return divided by the standard deviation of the return. So let's think about we have returns on a monthly base. Then, of course, you can calculate the standard deviation of that return. That's not a big deal. But what is meant with excess return? That's quite easy. Normally, in normal times, we have some, not high, but some interest rates just on money. Today was EZB interest rate decision. They keep it at more or less zero. So everything above zero is already in excess. So just the average return divided by standard deviation of the return would be in nowadays would be exactly the Sharpe ratio. The good thing about Sharpe ratio is that you have a comparison. In a way, average return is okay. And what would be ideal? Ideal would be to have constantly, for example, a monthly return of 1%. And if that would be really constantly, then the standard deviation would be zero. And then we have a very high quotient. In this case, it would be infinity, but anyhow. So but think about normal trading strategies. Of course, you don't have a constant return every month. That would be good, but it's just a dream. So you would have a standard deviation not equal zero, and then you can calculate the Sharpe ratio. Not that bad definition, and more or less, if it comes to portfolios, and you think about the Markowitz portfolios, then that is more or less the definition how he is creating portfolios or comparing investments. But now you see, there's another one, value at risk. And value at risk emphasizes the risk side, which still we can look for the return and the average returns as well. But now we do it completely different. And I quote here just Wikipedia for the definition of value of risk. Value at risk is a measure of the risk of loss for investments. It estimates how much a set of investments might lose with a given probability, given normal market condition in a set time period, such as a day, month, or year. So you get already a glimpse on value at risk. So it's try to estimate how much and how often you might lose a certain amount of money. That's good. If you have a view on the risk side and the potential losses of any investment. And therefore, I really like value at risk as being a quite good key figure. But now it comes to the definition of value at risk. And in principle, value at risk is based on three, let's call them parameters. Like normally we have, for example, an EMA, then there's one parameter of the EMA, which is the period. And in this case, we have let's call them three parameters, or at least we need definitions. And the first one is simply the return time. So on what base we are looking? Are we looking for daily returns, monthly returns, yearly returns? It's similar to Sharpe ratio, where you have to know on what time, let's call it period, we are looking. And of course, my favorites are monthly and yearly. Daily is for investment, maybe we could use this as well, but anyhow. But now it looks really bad. I mean, now we're really diving into deep mathematics. We're talking about so-called quantiles. But it's not a nightmare. It's quite easy. I will give you an example. And that is more or less a threshold, and typically that threshold is given as 1% or 5%. And you don't have to be disappointed right now. Practically, it's much easier than the example I show you now from the Wikipedia website. There's a good article and there's a good picture, and I use that picture. Normally, when we talk about value at risk, you would show up with a histogram of your returns. maybe daily, maybe monthly, yearly returns. And then you get, you can create a histogram, which means you have the probability for a given return. And here in this picture, you would see, okay, the highest probability for you can find is for 1% return. And if you look for even higher returns, then the probability goes down. And if you go to negative returns, it goes down as well. But you have numbers here for negative returns as well. And now, what is meant with the 1 or 5% quantile? It's exactly that threshold when that area has a percentage value of the total area. And for example, if you look for the 5% quantile, it would be exactly that red area. And now the value at risk for that histogram, that probability distribution, would be minus 8. Hey, that's now the value at risk. But what does it mean? We'll come to that. And the good thing is when you try to get value at risks for your investments, your values of interest, stocks, indices, investments, it's easier to calculate than you might think, and we will do it practically. So, but first, the third parameter we have to look for is we have to define on what time period in total we are looking for those returns. So the considered time is of interest as well. So what you can do, of course, is you can do it since inception. And for Dow Jones, we will do it since 1896 in this case. So of course you can always start with the inception date for any investment, and you have historical data for that. But you can go for a smaller time frame as well. So you can just look back maybe 5 years, because you might think, what's even more in the past, I don't care anymore. So that is the third parameter you need. The result is always a loss percentage. So like in the Wikipedia website, it was minus 8.2. So that was a value at risk, minus 8.2 in this case. But what does it mean? And now it's really quite easy. Let's do a practical example here. If we set that quantile to 5%, and now, because quantile is really, I think not that well known, think about what does it mean 5%? 5% means 1 divided by 20, which equals exactly 0.05, so 5%. Because now it is much easier. And think we are looking for a yearly consideration. And now if your value at risk is 6%, better would be to say it's minus 6%, but anyhow. So a value of risk of 6% can be interpreted as that every 20 years you might have a yearly loss exceeding the 6%, so even heavier, so minus 7 or something like that, minus 6.5 every 20 years. And now you see the translation of that strange quantile is quite easy. If we set the level at 5%, it's every 20. And if we are looking for a yearly consideration, it's every 20 years. If our base would be a monthly consideration, it would be every 20 months. So if we have such a value at risk of 6%, so every 20 years we might expect losses higher than that. Okay, but that is good to know something like that, because then it will set up our mind about any investment. And even better, we can now compare different assets, different investments, exactly with that kind of key figure. And that's really good that we can do it. And it's always based on the risk, and that is sometimes even more important than the return, because the risk is the one which might ruin our investment. To have less return, at least will not ruin you. Therefore, to be always risk orientated is better than to be too much on the return side. I hope that is already a good understanding. And when we do it practically just here in Excel, or in my case, LibreOffice, it will be quite easy. I will show up you some examples, but now I mentioned something that based on value at risk, there's a complete company which is really based on that kind of principle. And you might even know that company. They offer investments. So you can say, I have 5,000 euros and I want to invest. And I want the company to create a portfolio of ETFs with a given value at risk. That is your number you are telling that company. And maybe you say, okay, 10%, that's my value. So it might be that every 20 years, because they are using the 5% quantile, every 20 years I have a loss exceeding 10% and then 5%. And then that company is creating an ETF portfolio, and your money will be invested. And the company's name is Scalable. The German company Scalable, and now the company is worth more than 1 billion. Oh, not that bad. And everything, honestly, is based on value at risk. They even write it down. If you go to the website and really scroll to the very end, then you can download a so-called white paper, and they explain how they are doing all their calculations. It's an interesting paper. It's worth to read. So I can only recommend that. So value at risk, an underestimated key figure. I would say if you can build up a company with more than 1 billion exactly on that key figure. Very nice. So my examples here, and I will really do it practically, I will start with the Dow Jones, and I will really use the complete history because I have the history, or you as well, because I show you where to get it. Since more than 100 years, we have numbers for the Dow Jones, and we can do it on a monthly and on a yearly base. I will do both, and then it will be quite obvious how to calculate a value at risk practically, and how you can do it really by your own. Then I will do a comparison between DAX and S&P 500, and if you like, we can look for some stock companies. Then just mention some names here in the chat, and we will do comparison between those stock companies just based on value at risk. Okay. Finally, I mentioned here already what it means in general when we talk about value at risk. It's quite objective key figure, and it really enables us to compare different kind of investments. There's a disadvantage because we have no number for the potential loss, which we might have every 20 years. But there's an alternative, and I will introduce that as well. And the alternative is a so-called expected shortfall. It's really easy to do that as well. But now let's really start. And starting means we first need data. And since we go for daily data, I will use the website, which is called stock.com. And if you see the name once again, it's really nice written. It's STOOQ. So not the English stock, but it's a Polish website, and I assume that is a Polish word for stocks. Anyhow, and here you can find really thousands of investment, and I will go for the Dow Jones. So you can download almost anything here. And in this case, the data start at 1896, which is really nice. And then we can simply download those data. That should be done in a few seconds. And after we have downloaded the data, we can import those data into Excel. For me, it's just a double click. And I use not Excel, I use LibreOffice. And here we have the data. Good. Let me enlarge my screen a little bit here. Good. So volume, we don't care. I delete. And we would really like to see the date. Honestly, the data start with not really open, high, low, close, just close prices anyhow. For statistical considerations here, it's fair enough to have those close price data, and further down the time, then they are really open, high, low, close, as you can see. And there's another drawback here within the data. In 1914, there's a gap for 100 days, but I don't care about that. But it's nice to have a long history, because then we have more statistics here. So first, what we have to calculate is a return. And now I want to go for monthly return. Let's start with that. So our first data point is the 27th of May. Then I look for the next 27 doesn't exist. It's weekend. Anyhow, then I go for the 26th, and I want to keep it really simple. So what I just calculate is the percentage return based, or if you would have started your investment on the 27th of May, then 1 month later you would have earned, or you would have lose that amount of money. And in this case, that would be a loss. But anyhow, so you see, we have just a monthly return now here. And I simply go with that number down the table here, so that we have all the returns, all the monthly returns calculated. Whether that is always exactly 1 month, or because of the weekend, one extra day or 1 day less, I don't care. It doesn't really change the overall picture. And all the numbers above I fill with zeros, because we don't have data there. It's tricky and easy part now to calculate the value at risk for Dow Jones on a monthly base. We just take the two columns, we copy them, and we open a new sheet, and we insert those numbers, but not by Control V. No, we need the special insert, because I only want to insert the numbers and the formats. Otherwise, we would have here an equation, and that would be not anymore right. And now we have a simple table with date and return, and all we have to do is we have to sort them descending. We can have a look for that. So we have the highest return now on top here, and the lowest return at the bottom. And it would look like this one here. And that is always something I call, and you know that, a pseudo-histogram, because we can use that in order to get directly the 5% and the 95% quantile. That's now no problem. You see, because they are ordered descending, so we have had the highest returns 1932, with exceeding 50%, but you know what has been a couple of years before. And if I jump to the other side, and you see that we have 32,000 data points here, we have even losses of minus 40% within 1 month. And that has been 1929. Of course, you know, deep depression. Okay, you may think that's fine, the history. Okay, let's go a little bit upwards. Now, here, just one page upwards, 2008 is quite high in our hit list, or better to say, quite low, down in the hit list. There we have had a monthly loss of 25%. Wow, that's not a small number. And you see other months have been here around with 25% as well. Okay, that is our return. And now let's go for value at risk. We remind ourselves to the number of rows. We have 32,052, and that's the number we need. 3252, 51 entries. So that's the number of data points we have. And now it's really easy to get the 5% value and the 95% value. All we need is we need to look in the right row, and that's all. So we need, on the one hand side, we need the row with the number 1206. That would be the upwards potential of our value at risk. That is not a number which is commonly used, but we will look for that as well. And we need that value, 95% of here. That is the column 30,485. And now it's really easy to get the value at risk. Let me change the order. So, no, anyhow. All I have to do is I now go to the cell B 1603, and here for the cell 30,449. Oops, to that cell. And that's all. What you have here is the value at risk with a 5% quantile. Isn't that easy? Isn't that easy? That's a calculation. Now we know that the value of risk of an investment in Dow Jones is minus 8%. Or in other words, because we are looking to a monthly table here, every 20 months we might expect a loss of 8%. And it's really that easy to calculate the value at risk. You don't need a real histogram or something like that. No, it's really easy. That is all we have to do. And we can even do a little bit more. So the other one we might be interested in is simply the average. And that is from here to the very end. And that is 0.6%. So if an investment in Dow Jones historically gave us 0.6% as a monthly return. And if you translate that to a yearly return, it would be, you can just multiply it with 12. So it would be times 10, 7 point something percent. For small numbers, it's okay if you just multiply it with 12. I know the real calculation is a little bit different, but for numbers not too far away from zero, it's okay to do it that way. So we can get the average return as well. And finally, I mentioned already a disadvantage of value at risk. And one solution is to go for the expected shortfall. That's the name of that key figure. And to calculate that is, once again, quite easy. It's simply the average of all the losses behind the value at risk. So it would be the cells B 30,449 until the very end. Since I don't know it, I just go for that value. And that is the so-called expected shortfall. It's simply the average of all the losses behind or below the value at risk. So we can measure now the value at risk of a given investment. And it's really straightforward and quite easy. In this case, we have 8% on a monthly base, and we have an average of 0.6%. To do the same thing now for that was Dow Jones on a monthly base. To do the same okay. Once again, I want to save it. Now I got it. So, and now I want to change everything so that we have a yearly consideration. So I'll save it once again. So then I have both as final end. How to do it yearly? It's quite easy. Okay, this was a little bit misspelling, but anyhow, all we have to do is we change our calculation of the return. So 27 May, and now we simply go for the next 27 May, which is here. Okay, so we only have to change the numbers here, and the cell E2 is the top cell after the title, and we have now the yearly return, and all above I go for zeros. And now we do the same step as before. We take those two columns, insert them here. It's not done. Oh, still calculating. And so we insert the numbers. My fault has been first always delete the picture, because then it takes such much time here. So unfortunately, I forgot to delete the graph first, and therefore I have long running times here. And you remember, all we have to do is we have to sort the data descending, and here we go. And now we have the value at risk on a yearly base, and the value at risk is, let's call it 25%. So interpretation, every 20 years, we might have a drawdown or a loss of 25% every 20 years. And the number every 20 years stems from this 5%, because that is 1 divided by 20. That's the logic behind. And you see the average yearly return is indeed 7.5%, so my estimation was not that bad. But still, an investment in Dow Jones might create a loss every 20 years exceeding 25%, which is the definition of value at risk. And the expected shortfall here, in this case, would be 35%. And to make the story complete, the other one here is a 95% value interpretation. Once again, quite easy. Every 20 years, we might have profits exceeding 40%. So that's the upside of any return in Dow Jones. But that's how it's running and how you can calculate the value at risk even by your own. So what I mentioned else is that I want to show you the comparison of DAX and S&P 500, but that is now not done manually. I have prepared that already. And in this case, I look for data since 2000. And I look for data on a monthly return. For a monthly return, that was the calculation here. And the reason to do that kind of investigation between DAX and S&P 500 is simple, the question, what might be the better investment? An investment into DAX, you may think about for the DAX itself, or you may buy an ETF on DAX, and same for S&P 500. And we can answer now that question. How? Let's look for the value at risk. And so here we have the value at risk starting once again here with historical price data, calculating the monthly return, and then doing the same here with our extra sheet. And answer is value at risk close to 10%, average return 0.45, expected shortfall is given here as well. And that are the numbers for the DAX. And now let's have a view on S&P 500 as well. And I shift everything here, then I have them close to each other. And now we can look for the same kind of numbers for the S&P 500. And what do we realize? The value at risk for the S&P 500 is minus 7.5%. So the S&P 500 has a lower value at risk, so it's not that risky to invest into the S&P 500. And happily, and that's really, that's not a mistake, the average return starting from year 2000 is the same for both. But that is, when I saw that first, I thought maybe that's I did something wrong with the calculation here. But now if we go for 3 digits, you will see that those two numbers are not exactly the same. So it's just by chance that they're close to each other. But in this case, since the average return is the same more or less for both, but the S&P 500 has a less value at risk, then I think the answer, which kind of investment is a better one, is really quite easy. So that's the way how you can use the value at risk as a key figure to compare two investments. And now let's do it for other things. You might have your watch list, like stocks, or you might think about funds, or you might have a trading strategy and you want to compare that with the risk behavior of S&P 500 or the risk behavior of the DAX. Everything is valid and everything is possible with a key figure, a value at risk. And yeah, I have already two from yesterday's webinar, 2 stock companies which have been named to be investigated, and one has been Apple, and the other has been Deutsche Telekom. And so that is Apple, and here we have Deutsche Telekom. Okay, let's move the Deutsche Telekom here, and let's have this one here. And I did this just for 5 years backwards. So I started with the data from 2015, and same logic, everything, just downloading the data, calculating the return on a monthly basis. In this case, copy paste those into a new sheet, sort them, descending, and then looking for the number of data we have. Then we know where to look for the value at risk. And here we go. Here's the answer. Apple has a value at risk on a 5% quantile on a monthly base was close to 30%. Quite risky. On the other hand, Deutsche Telekom, you may know that company, maybe not, anyhow. It's not that bad if you don't know that. But anyhow, value at risk of Deutsche Telekom is less, 8%. So if we just look for what kind of investment is more risky, of course it's Apple. But if we put another thing into our consideration, the average return, then for Apple, the monthly average return for the last 5 years on a monthly basis, 2%. Whoops. Every month you would have earned 2% yield. That's not that bad. That's exceeding the 25% per year. So high returns on that stock company. And on the other hand, looking for Deutsche Telekom, oops, a 0.15. Okay, times 12 would be not that bad, 2-3%. Okay, that's not that much. So we, of course, we have less risk, but more or less no return. The good thing is we have a key figure in order to look for the returns. We have other key figures to look for the risk. The one that was value at risk, and the other, just for example, the average return. And that's really cool to have numbers like that answering the question of risk and answering the question of returns. And to have both is even better. And that could be a base for your investments decisions as well. And by the way, we have already introduced the expected shortfall as being another key figure, which is quite good to be used. So now that's a story about value at risk, and you might use that key figure, and you can really do the calculation by your own. It's not a big deal. And if you have interest in those Excel sheets we have had here with in the webinar, just drop me a line to s.friedrichowski@jfdbank.com, and I will forward those Excel sheets to you as well. But my summary here, today's nutshell, value at risk is really an interesting and a well-suited key figure for any evaluation of investments. And there's even a big company called Scalable, which is based on that key figure in order to create portfolios. Customized, really customized for the risk level, the customized setting. So that is quite cool. The value at risk emphasizes really the risk consideration, which is really good when we look for investments, that we have always a good look on the risk side and not only on returns. And it offers us the possibility really to compare different investment products, different trading strategies on the risk side and on the return side with all the other key figures we have in mind. That's the story about value at risk. I hope you find even that webinar, once again, quite interesting. At least I hope so. And for me, I have a good time for today, the rest of the day, and enjoy. The weekend is still a little bit too early. We have the Friday in front of us. So happy Friday is there. And for you, all the best. See you again and have a good time. Bye-bye.